Okay, let's get going. So for more than 2 decades, Foundation Source has powered people and companies to create a better world through philanthropy. Wealth advisors across the country partner with Foundation Source to provide private foundation services to their high net worth and ultra high net worth clients and prospects. Thank you for joining us today. Before we get started, some housekeeping items. The session will be recorded and sent to you after we wrap up today. If you have any questions, please drop them in the Q&A box at the bottom of your screen. Any questions that we don't get to today, we'll follow up with the answer. I'm Jeff Haskell. I'm the Chief Legal Officer at Foundation Source. And with me, I have Brad Bedingfield, Partner and Chair of the Nonprofit Practice Group at Hemingway & Barnes. Well, thank you, Brad, for joining us today. Really appreciate your time and for talking to us about the proposed regulations that were introduced mid-November 2023.
Thanks, Jeff. Great to be here.
Well, so Brad, DAFs are often confused with private foundations. Can you please give us a 1,000-foot high overview of the basic differences between a donor-advised fund and a private foundation?
Sure, Jeff. So conceptually, a donor-advised fund is just a fund inside a public charity, like any other fund that a public charity may have, while a private foundation is its own separate legal entity with separate control structures and separate rules that apply. For tax purposes, originally, donor-advised funds were treated like public charities, and because they were just funds at public charities like any other fund. Over the years, because donor-advised funds have a tighter relationship with their donors than other kinds of funds that public charities tend to, donors don't have any control over those donor-advised funds. That's a very important aspect of this from a tax perspective. But they do have advisory relationships with the charity that's hosting the DAF sponsor, the donor-advised fund. And so Congress and the IRS have always thought that they're kind of like private foundations in certain ways. So back in 2006, Congress enacted a new set of statutes addressing donor-advised funds and giving them some private foundation-like tax restrictions. So now donor-advised funds are a little closer to private foundations than they were, at least before 2006, but there are some differences in the tax treatments between the two, and some of those differences favor donor-advised funds, some of them favor private foundations. So just for example, donor-advised funds often get a better tax deduction depending on the situation for the donors. They're also not subject to the net investment income tax, the 1.39% tax that private foundations have to pay on investment income. On the other hand, private foundations can do certain things donor-advised funds can't. For example, they can pay compensation to related parties as long as it's fair, something donor-advised funds can't do, even if it's fair compensation. And they can make grants to individuals. Private foundations can, which is something that donor-advised funds are completely restricted from. So those are just some examples, but people do think of them as sort of in the same universe with some differences.
Well, thanks, Brad. Well, as you said, back in 2006, the Pension Protection Act created a statutory framework and a definition of a donor-advised fund, or DAF, and special rules applicable to DAFs, but we've been without regulations now to interpret those statutory provisions for some time, going on 16 years now. Practitioners originally had to interpret this and fall back on those statutory provisions, and they originally had till January 16th now to provide comments. Of course, that date's now been pushed back to February 15th, but rumor has it that the final regulations are going to be fast-tracked and may even be issued this year. And my understanding is that the final regulations are going to be effective, at least per the proposed regs, in the same tax year in which they're issued, instead of in the following tax year. So, for example, if you have a calendar year sponsoring organization, that's a charity that's hosting the fund, the final regulations will be in effect really as of January 1, 2024, if they're adopted by the end of 2024. Is that right? Is that typical?
Yeah, it is right, and it is not typical, at least in the context of a tax-exempt world. Yes, you're right. So the proposed regulations came out a couple of months ago in November and indicated that the Treasury Department would be accepting comments up through January, middle of January, right about now. They've deferred that for another month because so many people are submitting comments to this. But the proposed regulations make clear that under the that once final regulations are issued, they'll be effective as of the beginning of the tax year in which they were issued. So yes, if you're on a calendar year and they're issued on December 31st of 2024, they'll be treated as effective now. And we are currently working under a regime that where certain kinds of transactions and structures might be subject to tax, but we don't know yet because we don't know what the final regulations look like. I think that the reason that Treasury did this is because I think Treasury felt like their interpretation in the proposed regulations, which we're going to talk about in a minute, is sort of how they've always looked at the DAF rules, that is how they've interpreted those rules for 16 years. And so nothing is changing. The reality, though, is that we've had 16 years with very little guidance from the IRS as to how to interpret this relatively small body of statutes. And practices have developed that are not unreasonable interpretations of those statutes, but that are inconsistent with those proposed regulations. And so a lot of people are pushing back on the IRS and on Treasury, first off, on this timing rule, saying if you're going to make changes like this, or interpretations that really butt up against what a lot of people are in good faith doing, those need to be prospective only. So hopefully Treasury will hear that and the proposed regulations will be forward-looking. But the risk remains that they might be applied retroactively. And so I work with a lot of charities that sponsor donor-advised funds that are making changes now in anticipation of some of the things that are signaled in the proposed regulations.
All right. Well, so I guess it's unsurprising that given the vacuum of regulatory guidance, you've had these practices that have filled the void. Yeah. So look, Brad, word on the street is that the definition of the DAF in the proposed regulations is really much broader than the statutory definition or what everyone has thought it to mean. Is that right? And if it is, in what way is the definition in the regulations broader?
It certainly is broader than I thought the definition of a donor-advised fund is. So prior to the proposed regulations that we got a couple of months ago, we only had the statute really to base that off of, and a few other notices and things. The statutory definition of a donor-advised fund is a fund at a public charity, which is, there are two prongs to this. First prong, that fund is separately identified by reference to contributions to a donor or donors. The second prong is that with respect to that fund, the donor has or reasonably expects to have advisory privileges with respect to distributions or investments, either the donor or somebody the donor designates. We call that a donor advisor. So those are the two prongs. One, the fund is separately identified with reference to the donors. Two, the donors or their designees have these advisory privileges. If you fail either of those prongs, it's not a donor advised fund. It has to satisfy both of those prongs. Now, one of the problems, at least in my perception with the proposed regulations, is that it takes an extremely broad view of both of those prongs. With respect to the first one, separately identified, when is a fund separately identified by reference to the people who have contributed to it? I think many of us thought that there needs to be something special about that fund. So if I set up a donor advised fund, that's Brad's donor advised fund, and Brad is listed in the agreement as having some advisory privileges, and they send special reporting to me. There's something different about that fund vis-a-vis me and the fact that I contributed to it that makes it separately identified with respect to me. But the Treasury Department took a much broader view and said, if the charity, the DAF sponsor that's hosting these donor advised funds, is keeping track at all internally of who gave to which fund, those funds are separately identified with respect to those donors. Well, the problem with that is that every charity that is doing its job, proper bookkeeping, preparing for audits, keeping acknowledgement letters, things like that, all of them have written internal records of who contributed to which fund. So if that is the only test for when a fund is separately identified with respect to donors, then every fund at every charity is separately identified with respect to donors. So in my view, that if that broad an interpretation effectively regulates out that prong entirely and says all funds are, I don't know that that's the way that Treasury is looking at it, but that's the way I interpret it, that all funds are really going to be, on a practical matter, separately identified with respect to their donors if there are internal records in that regard. So that puts all the pressure then under the proposed regulations on the second prong, which is when does a donor or the donor's designee have or reasonably expect to have these advisory privileges with respect to either distributions or investments. And there again, the Treasury Department has put forward a very broad interpretation of that, such that, and there are all sorts of different flavors of committees and different things in different contexts, but broadly speaking, anytime a donor or somebody that the donor designates or is even aware of that is specifically designated as having some special relationship with respect to advising the charity on that fund, that's going to make the fund a donor advised fund, even if they're serving on a committee, various other circumstances. There are exceptions to that based on how committees may be composed, based on a couple of special situations among scholarships and disaster relief funds. But broadly speaking, the requirements for a compliant committee are difficult to uphold in practice. Has to be someone who has special expertise. There needs to be a minority of donors on the committee, or even a super minority of donors on the committee in some circumstances, and none of them can contribute to the fund, which cuts against standard practice for, say, community foundations, where you try to engage these committees to contribute to the fund. So these very, very broad interpretations of those two prongs mean at the end of the day that vastly more funds at community foundations and other DAF sponsors, that funds that people don't think of as donor advised funds, are going to be treated as donor advised funds and subject to these special restrictions.
Wow. So what is the practical consequence, though, of the wider net cast by this broader definition of a DAF?
Yeah, so donor advised fund sponsors host a range of funds. Many of them, like community foundations, will have donor advised funds. They'll also have things like field of interest funds. We're going to support artists, and everybody can contribute to this fund, and we're going to, in a collective way, apply that to fill a particular need. Or other special kinds of funds like memorial funds. Many of these kinds of funds can do things that donor advised funds are not allowed to do. So donor advised funds are really, really good for making grants to public charities. If you're making grants to any other kind of organization, which you can do for perfectly good charitable purposes, then you have to follow some special procedures called expenditure responsibility, which many of them aren't equipped to do. One of the great restrictions on donor advised funds is that donor advised funds can never, ever, under any circumstance, make any grant to an individual. This is one of the big differentiators between DAFs and private foundations, which are allowed to do that under certain circumstances or with certain conditions. But for donor advised funds, they never can. So if you set up a scholarship fund, its whole purpose is to make grants to or for the benefit of individuals. If you don't do it in a way that complies with the statutory and regulatory requirements for these committees, then that fund can't make the grants that it's making. Or if it does make those grants, it's going to trigger a tax on the organization. Funds, like I mentioned, that many community foundations will have field of interest funds, like funds that support artists, for example. We saw this a lot during COVID, artists who couldn't perform, and now we're having trouble making ends meet. So community foundations would set up an artists fund that would then support these folks. Well, donor advised funds couldn't do that directly because they're not allowed to make grants to individuals. They could make a grant to the field of interest fund, which then could support those individuals. But if now the field of interest fund is treated as a donor advised fund because of these broad interpretations, then that is a problem. It can no longer do the kind of charitable work that it's doing. Where this is really a problem that I see some of my clients currently dealing with and trying to restructure is with memorial funds. So imagine, and this is a real situation, that a teenage child passes away tragically. The mother sets up a memorial fund. We see this all the time to try to support in honor of the child, to support the things that the child was interested in. The fund is set up maybe at a community foundation. The mother is given a special role with respect to the fund because it's the mother and she knows what her son would have wanted. Maybe it's to help pay for youth to have access to sports programs that they otherwise couldn't afford. That's a grant to an individual. So if this memorial fund, even if the mother never contributed to it, if the proposed regulations make clear in a fact pattern like that all these people who are contributing to this memorial fund are deemed to have designated that mother as their donor advisor, the community foundation it has physical records of who contributed to that fund. So that makes it a donor advised fund, meaning that the memorial fund can no longer make those grants to the individuals.
Wow, that seems like a real perverse result and not what I would thought Congress would have intended. But perhaps,
Yeah.
what do you think of that?
No, yeah, I think it is. I think that this is an overly literal interpretation of the statutory language, and one that has real consequences that I'm not sure Treasury has really fully thought through in terms of chilling charitable activity that is not the sort of perceived abuse that Congress was attacking in 2006. And this point is being made by a number of industry organizations, professional organizations that are submitting comments to Treasury right now on this and on other aspects of this. So hopefully that will have some effect in the final regulations, but we'll have to wait and see.
So you're saying that sponsoring organizations may have maintained funds that were not thought to be DAFs at all, but under the proposed regulations would be considered DAFs. And so what's the consequence of that, practically speaking?
Yeah, so take my memorial fund example. If folks set up this memorial fund, it's not the kind of fund anybody thinks of as a donor advised fund. But if now it technically is treated as one because of this broad reading of the proposed regulations, then to the extent that memorial fund makes payments to or for the benefit of individuals, that triggers a penalty under the taxable distribution rules for donor advised funds. And that penalty is imposed on the charity, on the donor, the DAF sponsor. So they'll have to stop making grants to individuals from those types of funds, or they'll have to greatly reduce community involvement on the committees of those kinds of funds. So you can't have the mother of the person who died specifically designated as being on that committee. You can't have donors on that committee. Committee members can't be substantial contributors to it. Again, there are rules about how to make the committees compliant, but in my practical experience, those rules butt up against the reality of how organizations like community foundations often set up these kind of structures in a way that really doesn't butt up against what Congress was trying to attack in 2006, but does butt up against the proposed regulations. And
So, go ahead.
No, just one other thing. The contributions to donor advised funds are tax deductible. To get that tax deduction, you've got to get an acknowledgement letter from the charity. Acknowledgement letters have to say certain things. If it's a grant to a donor advised fund, it's got to say some extra things that normal acknowledgement letters don't necessarily say. In particular, it's got to say that the DAF sponsor has exclusive legal control over the funds. That's a statutory requirement. And there are cases out there now, recent ones, where the IRS has denied very large tax deductions to donor advised funds because the acknowledgement letters didn't have that magic language in it. So now if people are contributing to funds that they don't think of as donor advised funds, like these memorial funds, but the IRS comes back and says, no, that's a donor advised fund. Well, now all the people that contributed to it potentially lose their tax deductions because their acknowledgement letters don't have that extra magic language in it. So that's another concern about this broad interpretation of what is a donor advised fund.
Yeah, you beat me. I was going to ask you what we have. One of the questions that have queued up is what impact would the expanded definition potentially have on the donor?
Right.
And so you nailed it, that potentially could be a loss of a deduction. So Brett, look, my understanding is that the proposed regulations provide definitions of donor and donor advisor. Are those definitions also broader than anticipated? And if so, how?
Yeah, they are. And just quickly to go back on the tax consequences here, we talked about the tax consequences of direct contributions and the acknowledgement letters that you get, but it also affects other things like direct charitable distributions, qualified charitable distributions from IRAs, which you can make to a field of interest fund, but you cannot make to a donor advised fund. If suddenly a field of interest fund is a donor advised fund, then that qualified charitable distribution treatment from the IRA may be in jeopardy as well. So with respect to the definitions of donor and donor advisor, as I mentioned before, the DAF rules apply whenever a fund is separately identified with respect to the donors or their advisors. Whenever advisory privileges regarding distributions or investments are offered to the donor or a donor advisor who is someone the donor designates to have those advisory privileges. Where the donor designates like a friend or somebody to say I want them to advise on investments or distributions. Clearly, that implicates the donor advised fund rules. But the proposed regulations make clear that this treatment applies as well to professional investment advisors who were hired by the donor advised fund sponsor, but at the recommendation or participation of the donor or other donor advisors to provide investment services to the donor advised fund. So here, the proposed regulations are taking direct aim at something that has become a pretty common industry practice in the donor advised fund industry, both with so-called commercial donor advised funds and with community foundations as well, whereby a donor wants the donor advised fund assets to be invested by the same investment manager that manages their personal assets or their private foundation assets. And the donors like that because it provides a sort of holistic investment approach to what the donor thinks of as their philanthropic pools, their private foundation, which they can directly control, their donor advised funds, which they can't control, but where they have an advisory relationship. From the IRS's perspective, though, this is potentially abusive because they're afraid that the donors and the investment advisors will collude to keep the funds under management and not make DAF distributions. While I don't think this is borne out in my practical experience with donor advised fund sponsors, that seems to be a big part of what Treasury is worried about. So the new proposed regulations would say that for the most part, your personal investment advisor can't also be advising the donor advised funds. However, with a 16-year gap between the enactment of the statutes and the proposed regulations, this has become very, very common. So it's going to be difficult to unwind. And as we mentioned, if there's retroactive application of this, some people may be subject to tax penalties now for these arrangements that are currently in place.
And that could affect the donor advisors and the donors personally, right? In terms of the penalties?
Yeah, no, it absolutely could. So there's just to be clear here, the problem doesn't necessarily arise just because your personal investment advisor is investing the assets. The problem arises from the fact that DAF assets are being used to pay the personal investment advisor. So there are a number of different sets of rules around prohibited benefits from donor advised funds. One of those has to do with compensation, and it says that anyone who is a donor or a donor advisor designated by the donor to provide investment advice or distribution advice cannot receive compensation of any kind in any amount. If they do, that is a per se excess benefit transaction. This is under section 4958 of the Internal Revenue Code, and it's subject to a tax penalty. So the personal investment advisor who is in this relationship is potentially subject to this tax. In addition, the donor advised fund sponsor could potentially be subject to a tax because the proposed regulations make clear if you pay an excess benefit amount like this, that's an impermissible distribution. So under the taxable distribution rules, that can trigger a penalty as well.
So, look, I'm just curious if you have an opinion on this, but if a donor advisor is one who can make recommendations regarding the DAF's assets or the investment of those assets, so why wouldn't an investment advisor have been considered a donor advisor even before the proposed regs were issued?
Yeah, the regulations, the statutes here references whether a donor or any person appointed or designated by a donor has these advisory privileges. So it's not an irrational interpretation necessarily of the statute to say, well, my personal investment advisor, I've asked the donor advised fund sponsor to hire them. They are appointed or designated by me because I've asked them to hire them. Therefore, they are a personal investment advisor. Therefore, they are a donor advisor and subject to these compensation-related restrictions. And that clearly is the interpretation that the Treasury Department is taking. I think a lot of folks, again, in the wake of any guidance as to how to interpret this language, felt that that these rules were intended to apply more to somebody designating a family member, designating a friend, not necessarily the hiring of a professional investment advisor as a vendor to the donor advised fund sponsor. I think there was just not entire clarity as to how far that extended. And so people took the position that, these professional investment advisors, they're in a bit of a different situation than what Congress might have been looking at in the donor advised fund statutory rules. They're subject to fiduciary principles and other sorts of standards in their provision of investment advice. And so maybe they're a little bit different and they shouldn't be treated as donor advisors. Treasury is very much pushing back on that and saying, no, they absolutely are donor advisors.
Could you walk us through the exceptions to the rule?
Yeah, so there's one primary exception here that they provide for in the proposed regulations, which is that if your personal investment advisor, the person who invests your own assets, you're asking them also to invest your donor advised fund assets. If that personal investment advisor provides investments to all or substantially all of the DAF sponsors' DAFs, then it's okay. Then the proposed regulations will treat the fact that they're also investing your personal money and in your DAF as incidental to the fact that they're investing everything. So if you've got a DAF with a commercial DAF sponsor, and that commercial DAF sponsor's affiliated investment shop is investing all the DAFs, and you also happen to have your personal money with them, then the proposed regulations would provide an exception for that. But if instead, somebody else is investing most of the donor advised funds and you're asking for your own investment advisor to be carved out to invest your donor advised fund, then there's no exception for that. That's going to be treated as a personal investment advisor, and any compensation to that investment advisor would be an excess benefit under those rules. What's not so clear is how far that goes in terms of being given choices. For example, you might have a DAF sponsor that allows you to choose from 3 different investment professionals, one of whom may be your personal investment advisor or may not. Now in those circumstances, you only have the 3 to choose from, but you're still making a choice. The donor is participating in that selection of one of the 3. And probably you never know how many people are choosing each of the 3, but it could be that the one you've chosen is only investing a third of the donor advised fund assets. That would not appear to me to fall within the exception that they have provided here. So at least so far, it seems to be an all or nothing exception. They provide investment advice to everybody, or if they do your personal investments, and in particular, if you played any role in their hiring, then they're going to be treated as a donor advisor.
And that's because the example in the proposed regs indicated that the advisor was providing services to all the donor advised funds across the board, right?
Correct. Now, Treasury, among the comments that they're requesting, one is for more thoughts from the public as to where the appropriate lines are in terms of that personal investment advisor characterization. So we'll see what comments people promote and whether they expand the exception a little bit more to something other than just one investment advisor investing everything as
Right.
sole exception.
Well, it sounds like the industry was really taken by surprise here. Any other surprises that we didn't talk about so far?
The big one in my mind, and one I've struggled with a lot in advising, in particular, some of the community foundations I work with, is what they call the Anti-Abuse Rule. So the Anti-Abuse Rule, is part of the taxable distribution rules. This is section 4966 of the code. And, under that rule, if the concern is where a donor advised fund makes a grant to a public charity, and then the public charity and the donor advised fund donor kind of whisper in cahoots and say, I want you to do something that the DAF couldn't do directly. So I want to make a grant to an individual. I'll make a grant to a third-party charity, but then the donor will arrange with them to have it go somewhere it couldn't have gone directly. So the anti-abuse rule says that whenever the donor or the DAF sponsor is arranging for that subsequent use of the funds, then we'll collapse the transaction and treat it as if the donor advised fund did it directly. And if the donor advised fund did it directly, and it's something they couldn't do directly, then there's a tax on the donor advised fund sponsor. And on the surface, this kind of rule is not crazy. We have similar principles in other areas of tax law involving earmarking, for example. If I make a grant from a private foundation to a public charity, and I've either required or there's a pre-arrangement that it's going to go to do something that the private foundation couldn't do directly, then the IRS can collapse that and treat it as if it's one transaction and tax the private foundation. The problem here, though, in this manifestation of that, well, there are two problems. One, with respect to grants going out to third parties, imagine a scenario where the donor advised fund sponsor complies with a grant request from a donor to go to a third-party charity, perfectly good third-party charity, not necessarily in the pocket of the donor or something. Now the donor whispers to that third-party charity, I want you to make a grant to individuals. The donor advised fund sponsor in that circumstance doesn't know or have any reason to know that that's happening over there. And yet, if the IRS collapses that under the Antiabuse Rule, the tax is on the donor advised fund sponsor, not on the donor. And so the donor advised fund sponsor can be hit with taxes because of something that they had no way of knowing was happening over here with respect to those third parties.
Well, I mean, Brad, that seems awfully unfair, especially since, as you mentioned, the donor and the donor advisor are maybe the bad actors here who are colluding under the table of the grantee. Are there any thoughts about how to make this provision any fairer?
Yeah, no, I think it is unfair, and again, I get where Treasury's coming from here. You don't want to facilitate an easy end run around the donor advised fund rules, but to impose a rule that could result in tax on a taxpayer, the DAF sponsor, that didn't know or have any way of knowing what was happening over there is generally unusual in the tax law. And so I think I would be inclined to, and I hope Treasury will do this, to modify that rule so that the donor advised fund sponsor is only going to be potentially subject to the tax to the extent that they knew or reasonably should have known what was happening at that second level. If they participated in that whispering conversation, then that's not necessarily inappropriate for them to be hit with that tax. But if it was just the donor doing that, then that's punitive.
Right.
So that was one of the concerns. The second concern that I have, and I don't know that Treasury was thinking about this, but I think that the way I read the proposed regulations, it's a concern. A lot of donor advised funds give to internal funds at the same donor advised fund sponsor, but that are not DAF. So, for example, Community Foundation, I mentioned funds for artists to support artists during COVID. A lot of DAFs would make grants to these kinds of funds. DAFs are allowed to make grants to field of interest funds at the same donor advised fund sponsor. So now it's out of the DAF and it's in this field of interest fund. And now the field of interest fund is making grants. And those could be grants to individual artists, for example, something the donor advised fund couldn't do directly. Well, if you read the proposed regulations literally, they say that whenever either the donor or the DAF sponsor, the charity, arranges for that second step subsequent use of the assets, that will be collapsed under the Anti-Abuse Rule. So a donor advised fund sponsor is always arranging for its own use of its own assets. So even if the donors advisors are not participating on the field of interest fund at all, they're not on the committee, they're not whispering to people, they just made the DAF grant and walked away, the DAF sponsor is still participating because they're the ones making the grant, no matter who might be serving on various committees. So taken literally, this could mean that donor advised funds making grants, even general purpose grants to unrestricted grants to the DAF sponsor charity, that DAF sponsor charity has to maintain the DAF restrictions on those funds, even when they're out of the DAF, because the Treasury Department appears to be concerned that the DAF sponsor will be doing all of this by way of collusion to get around the rules, move it into some other kind of fund, and then do what couldn't be done directly. That's a problem because it chills the ability to get money out of DAFs and into these other kinds of funds where you don't have those advisory relationships. And it makes it really, really hard for, say, community foundations to track its funds, because if you have to, you put DAF funds into the field of interest fund, but now you have to separately track what came from the DAF funds to make sure none of that gets used for, say, individual grants. That greatly complicates the bookkeeping and the accounting.
So what do you think they're trying to accomplish by broadening the scope of the rule to the sponsoring organizations arrangements with, with its own funds? What do you think they're really trying to do?
I don't know if they were thinking about that internal piece. The way that the proposed regulations are worded, they seem to be thinking primarily about these grants to third-party charities and then any collusion that's happening there to where it goes. I don't know that they put a lot of thought when they drafted this, because the language doesn't really signal that to me, into DAFs contributing to internal funds. But maybe they did, it's hard to tell. But from the literal language of the proposed regulations, I think that is implicated. So I think that the concern sounds from a sort of suspicion that's behind all these proposed regulations that unless we police it, the donors, the DAF sponsors, maybe third-party charities are all going to be in collusion to get around these rules. That has not been my practical experience working with donor-advised fund sponsors, but I think that suspicion is behind this, and that they're not comfortable relying on things like the traditional earmarking rules, because that requires a lot of proof on their part as to whether there was a pre-arrangement or something like that.
Well, look, the top of mind question that I have, I think many have this question, is whether or not you see a practical way to navigate compliance with this rule. Is there one?
Yeah, I'm struggling with that because I'm getting that questions from clients who are running donor advised funds. If you're really going to reduce risk with respect to these grants to, say, third parties, and you're concerned that the donors may be whispering to those third parties, but the DAF sponsor, I'm going to get hit with a tax if they do that, and it all gets collapsed. Then one way to handle that would be, when you make the grant to the charity, make the charity, agree in writing, we will not speak with any donor advisor, family member with respect to this grant. They are not arranging for its subsequent use. That doesn't necessarily prevent the collapsing if they then go and actually do that, but at least it gives you a sort of reasonable cause argument for avoiding the penalty. But that's difficult in practice. The third-party recipient charity would have to sign a written agreement every time a DAF grant comes out, and that's going to greatly clog the works mechanically in terms of these kinds of grants. And two, the third-party charity isn't going to know who's a family member, who's a donor advisor necessarily. It's going to be difficult to get that information over to them in a way that will allow them to sign, yes, we're not going to talk to any of those people about subsequent use of the fund. So my real hope is that the Treasury Department, when they get comments on some of the practical effects of these things, will step back to something closer to the typical earmarking analysis for something like that, rather than what at least I read to be a broader application of the anti-abuse rule.
Well, thanks, Brad. So we have some questions, and one of the questions we have is about expenditure responsibility on these distributions, because the proposed regulations, they seemingly would require the sponsoring organization to exercise expenditure responsibility or special oversight procedures for the provision of any services other than investment advisory services, and because those are explicitly carved out as an exception to the rule. But if the DAF incurs legitimate expense, like for legal services, and pays no more than fair value for those services, such that there's no donor development at all involved, do you think that the Treasury really intends for the sponsoring organization to exercise that special oversight expenditure responsibility or the disbursement?
Yeah, so first off, just to mention what expenditure responsibility is, if you're making a grant from a donor advised fund to something that's not a public charity, then you have to exercise expenditure responsibility, meaning the grant is made pursuant to a written agreement that says certain things. There's a reporting obligation coming back, and you comply with all of these very, very strictly. And your question, or the question, sounds in the definition in the proposed regulations of what is a distribution, right? So we know that if we make a grant out, that's a distribution, but they take a very broad interpretation of that in the proposed regulations. They say a distribution is any payment or disbursement, and then they provide an exception. The exception is for investments, and for certain kinds of investments, at least, investments that don't, as you say, have a donative element, and for reasonable investment or grant-related fees. Well, there's a lot that donor advised funds can do that may not just be grants and investments, right? And this seems to be the assumption behind the Treasury regulations definition, that DAFs are just making grants and doing investments. But DAFs can do other things. DAFs can do direct charitable programming. DAFs can hire service providers to provide charitable services in furtherance of their charitable purposes. Are those distributions that require expenditure responsibility if your service contract is with someone who is not a public charity? It would seem perverse for that to be the result, because one, how do you weave in expenditure responsibility requirements into a service contract? This is not a real natural way to do that. But two, if these contracts are with independent third parties, that's not the kind of abuse that Congress was worried about here. So there is concern that the broad language of that definition of distributions might encompass those kinds of payments. And hopefully Treasury will clear that up and say that if these are just service payments to third parties, not insiders or anything, that they should not be treated as distributions. They're just service payments.
I see. I think maybe we have time for one or two more questions. One question is, what impact would the proposed regulations have on so-called charitable investments?
Yeah, so with respect to charitable investments, there are a lot of gradations of investment in a charitable vehicle. An investment can be a straight up, I spent $1,000 to get $1,000 worth of Apple stock. That's just an investment, a change of one form of investment to another. Some forms of investment that charities get involved in have what you referred to earlier as a donative element to it. So we may make a low interest loan to a business in a deteriorated area for charitable purposes. It's an investment, or it could be an equity investment in such a business. It's an investment, but it's not a good investment from a pure investing standpoint. But we do it because there's a philanthropic element to it. In the private foundation world, we might call these program-related investments. And donor advised funds can do these kinds of things too. But the proposed regulations make clear, and this is not a surprise. I think this was something that we all expected, and many of us have been giving advice accordingly, that investments that have that kind of donative element, that are sort of philanthropic in nature, are at least to some extent in part distributions, and therefore should be subject to these rules for distributions from a donor advised fund if the donor advised fund is doing that, which means exercising expenditure responsibility. So I've worked with donor advised funds that have made low income loans for charitable purpose, or low interest loans for charitable purposes, or program related like equity investments. And we just weave into the documents the expenditure responsibility requirements, just like you would do if a private foundation were doing that.
Right. Okay, and I think we have time for one short one, which is based on your understanding of how this is being received by Treasury. How likely do you think that the final rates will stand in the form they are today?
Oh, goodness. I wish I knew. My suspicion is that the sense I've gotten from people I've talked to about this is that Treasury really does want to hear from us, that they really want to hear how these are going to affect real world situations, maybe ones that were not intended to be addressed by the statutes. They want to understand if there are consequences they didn't anticipate, and if there are reasonable compromises that still address the statutory requirements and the spirit of the statutes, but are, can accommodate real charitable purposes. I think they will be open to that. That's the sense I've got from speaking with various folks. So my hope is that, I certainly hope that they'll change their minds on that retroactivity element, because that seems a little bit punitive given the 16 years that we've all been trying to figure out what this means. But I also hope that at least on some of these points we've been talking about today, that they'll hear that in the comments that they're receiving, and at least create some more reasonable exceptions or reasonable interpretations of some of these terms.
Okay. Well, thank you very much for being with us today and talking to us about these proposed regulations, and especially the practical consequences of them that may or may not have been anticipated by Treasury when they rolled these out so recently, if there's so much time without them. And we'll do our best to respond to the folks who have submitted the questions. We didn't have time to get to them. We went a little bit past time, but hopefully we hit all the high points. And again, thank you again, Brad, and thank you all for joining us today for this webinar.
Thanks, Jeff. Thanks, everyone.
Bye.